watching Taking Stock on CNBC TV 18. Last week was a good one for us. In fact, the Nifty closed above 75.50. The Sensex very close to that 25,000 mark, led by firm global cues. So the big question is it just a dead cat bounce, or are all the rallies to be sold into? So to talk more about the markets in individual sectors, Vinay Khattar, the Associate Director and Head of Research at Edelweiss Financial Services, joins in. Hi Vinay, and thanks so much for taking the time out on the weekend and joining in. What's your sense now about the markets? Do you think this pullback can extend itself, or do you think the medium-term picture looks murky and therefore these rallies should be sold into?
Our sense is that, broadly speaking, the rallies don't appear to have strength at this stage. If Nifty ends up spending some more time at the current levels and shows a certain degree of strength, then probably you may want to hold on to stocks. But at this particular point in time, it looks that rallies are pretty weak, and given the overall global scenario, most of the time the rallies may likely peter out.
Vinay, hi, good to see you in today. Your sense in terms of what's happening with the banking space? Asset quality review has become the new buzzword which a lot of analysts are now concentrating on, and which is affecting a lot of banks' gross NPLs in terms of the reportage, at least this quarter. Your sense in terms of how you would read it, that maybe the pain is out of the system for most of them?
I don't think the pain is out of the system for most of them. I think the pain is still there, but the good thing is that at least RBI is forcing banks to report non-performing assets which were otherwise getting sidelined or were not getting the kind of attention that they needed to. Now, what was happening was that once the NPAs were not getting reported and all the analyst community was having doubt in terms of are they looking at the right number in terms of both gross and net NPAs, valuations were suffering a lot. So you found a lot of public sector banks where a number of these NPAs are sitting in on their balance sheet. They were trading below book value. Now, it doesn't make sense till the time you don't start doubting that the book value itself is genuine, or you are going to be taking significant more hits there. Now, with the very strict audit committee and audit review process that RBI is running, at least all the numbers are beginning to get reported. You saw ICICI Bank report very elevated gross NPAs, and also the statement that next quarter is also going to reflect similarly high NPAs. So this brings the cat out of the bag. My sense is that public sector banks, once they have reported their NPAs, and given that their valuations are so cheap, would benefit over a longer period of time that their balance sheets begin to clean up. One. Second big thing which will play out is that the government is now infusing serious amount of capital. So they had plans of infusing 70,000 crores last week. Incremental 26,000 crore announcements have come in. So that takes it almost a lakh crore of infusion over next few years into the public sector banks as part of government security. That's a reasonably large number, and once that begins to happen and overall macroeconomic pickup begins to play out, I think public sector banks over the longer period of time could become interesting bets.
Vinay, one of our experts told us, who we'd got on our channel earlier last week, said that in 2016 there was a 90% correlation between crude prices and equities. Last week we saw crude prices bounce back. There is some hope of supply cut. But do you expect the rally in crude prices to sustain even next week? And can that act as a positive trigger for the markets?
So whether the rally will sustain or not is anybody's guess. But my sense is that if the prices in crude sustain, then it is definitely going to be the positive trigger for the market. Let's look at what's happening on the crude scenario. Now, you had a clear war between within the OPEC itself, with Iran coming back with large supplies. And then you had differences between OPEC and non-OPEC countries, mainly Russians and Middle East guys, in terms of the production levels that each one is going to maintain. And since Russia is not part of OPEC, they kept on producing for last many years, having no restrictions and enjoying higher prices, while OPEC was forced to take production cuts to maintain prices. And the third big vector which is playing out in this industry is a kind of a battle between the sovereigns, the countries, and the private sector companies, mainly led by US shale producer and private capital. Now, sovereigns at this point have taken a very tough stance that they would want the prices to come down, because their marginal cost of production for most of the Middle East guys is very, very low at $10, $15, $20 kind of a scenario. Now, and while the shale producers are all upward of $50, So these three scenarios playing out, oil has taken a big beating. Our sense is that at some point in time this will begin to reverse. So if you look at the rig counts which are deployed on the shale, they are beginning to fall very significantly, and month on month the number is deteriorating. As per some estimates, almost 500,000 barrel of shale production will not happen in 2017 and balance part of 2016 because the prices have crashed so low. So overall, if the shale production begins to come down and there is some kind of an understanding between Russia and OPEC, and a degree of public statements have emerged from both the countries in last 7 days, you could see some degree of bottom formation happening in oil. And if that happens, of course, it's going to be positive for the market, specifically for countries like India.
Vinay, you have a couple of stocks that you're looking at, for example, Jamna Auto as well as Dalmia Bharat.
Yes, these are the stocks that we've been advising our clients to buy into. So let's look at Dalmia Bharat. Cement company, significant production capacities in south and east of the country, and southern part of the country has had excess capacity. So the capacity in southern part of the country is almost 120 million tons, and with what was happening on Andhra, you had utilization level which were very, very low at just about 55% or so. So most of the southern cement producers were suffering. Now, with the split of Andhra and Telangana, our research shows that whenever the states split, the capacity of the cement demand actually settles at much, much higher level than what it was for the unified state. It could be as high as 20, 30, 40% more. And Andhra was one of the largest consumers of cement in the country. So with Andhra and Telangana both becoming independent state, that number is likely to move up significantly. Second, in northeastern, again with focus of Prime Minister Modi and the current government, infrastructure projects are likely to come in and cement demand could again pick up there. But the big vector which we find that makes Dalmia very attractive is the way the company is run. It's almost become the third largest or fourth largest producer in the country at about 22, 23 million ton kind of an effective cement capacity. And the cost of production is the second cheapest after Sri Cement. So Sri Cement has total variable cost at about 2100 per ton. Dalmia is closer to 2300-2400 per ton. Now, this gives us a disproportionate profit benefits because I can price my cement well, my costs are very, very low, and I'm in segments which are geographies which are very good to do. So it's an interesting bet.
Okay, fair enough, Vinay. On that note, we're going to wrap it up. Thank you very much for joining in and talking to us. With that, it's a wrap as well on Taking Stock. Stay tuned for more news and updates and have a good weekend.